Welcome to the deep dive. So, you've given us this pretty hefty stack of sources, all centered around investing. Specifically, they're looking at building wealth using index funds. Our job today, to really dig into this material you sent and pull out those key nuggets, the insights you need to get well informed. Investing can seem, well, daunting,
Right.
especially getting started. But these sources, they jump right in, zeroing in on index funds. They offer this attractive mix of simplicity and effectiveness.
hmm
The basic idea is they just try to match a market like the S&P 500, not beat it.
Right. It's a passive approach.
Exactly. And the sources really hammer home that this passive way has actually been, well, incredibly powerful over the long run. As we got into it, the reasons they really champion index funds became super clear.
Yeah, there are a few big ones.
Cost is one, right? Lower fees usually compared to those actively managed funds.
Definitely. And diversification is built right in. You
Yeah.
get broad exposure almost instantly.
Simple too,
Good.
makes them very accessible.
And the big one, historical performance. The data suggests they often, actually frequently, outperform the active funds long term.
Yeah, there was an analogy in there that really clicked for me. Something like, imagine someone just starting.
Uh-huh.
With minimal research, they can enroll in a fund that mirrors the market's performance.
Yeah.
It makes it feel less like this huge mountain to climb.
Yeah, more like a clear path you can actually follow.
Okay, so index funds offer a pathway. But before we dive deep into the how, the methods, let's pause on the why. Why is building wealth itself something these sources emphasize so much?
That's absolutely foundational, isn't it? The sources are clear. Building wealth is way more than just stacking cash. It's really about building a stable financial future, a resilient one. They break it down into a few key areas. First up, financial security.
Right, the safety net idea.
Exactly. A buffer for those curveballs life throws: medical bills, losing a job, the boiler packing up. That peace of mind, it's huge. Then there's the generational side of things. Building wealth can lay a foundation for the next generation.
Like helping with education or their own future investments.
Precisely. Setting them up potentially. And another big one is the freedom and opportunity it creates.
How so?
Well, financial independence means you can actually pursue passions. Maybe travel, maybe start that business you've always dreamt of, or give back through philanthropy. The source is really connected to living a more, fulfilling life, one that's guided by your values, not just financial pressures. And of course, retirement. Comfort in retirement.
Yeah, retiring on your own terms.
That's the goal, isn't it? Without constant money stress, enjoying that phase. There's that story in there too, Sarah's story. It illustrates it quite well.
I remember that one. Started young, right?
Yeah, started investing in index funds at 25. A decade on, that consistency plus compounding. It wasn't just about the account balance.
They gave her choices.
Exactly. Freedom to explore writing, travel, her future felt more secure.
It really highlights that wealth building enables a life, not just, getting rich for its own sake. And the sources also gently nudge us about financial literacy. Just understanding simple tools like index funds empowers you, lets you make informed choices.
Makes sense.
And they lay out those first steps. Set goals, learn the basics, start early if you can. Compounding is key, and use things like index funds for that easy diversification. It's a journey, and understanding the why is the starting block, which, speaking of steps, leads us nicely into the first specific strategy your sources highlight.
Okay, method number one then, dollar cost averaging. DCA. Sounds kind of technical, but what's the core idea?
At its heart, dollar cost averaging, or DCA, it's really about consistency beating timing. The sources define it pretty simply. You invest a fixed amount of money, let's say $100 or $500,
Okay.
into an asset, like an index fund, at regular intervals, maybe monthly, maybe quarterly.
And the key part, regardless of the price at that moment, you just stick to the plan. And the real advantage, as the sources explain it, shows up when the market gets choppy, volatile.
Right.
When prices are down, that fixed amount you invest buys more shares.
Ah, okay.
When prices are high, the same money buys fewer shares. The goal isn't nailing the bottom, it's lowering your average purchase price per share over the long haul.
So it's like automating discipline.
Yeah.
Takes the emotion out of trying to time the market.
Exactly. You just stick to the schedule. It removes that temptation to panic or get greedy. The sources had a really clear example, didn't they?
Yeah, walk us through it.
Okay, imagine you decide, right, $500 every month into an index fund. Month one, the price is $50 a share. Your $500 gets you 10 shares. Simple enough.
Got it.
Month two, market dips. Price drops to $25 a share, but you stick to the plan. Your $500 now buys 20 shares.
Okay, so you got more for your money that month.
Precisely. Month three, Price recovers a bit, maybe to $40.
Hmm.
Your $500 gets 12.5 shares. Month 4, another dip. Price hits $10 a share. Ouch. But your $500 buys a nice chunk, 50 shares.
Wow, okay.
So over those 4 months, you've put in $2,000 total. And you've picked up 10 plus 20 plus 12.5 plus 50. That's 92.5 shares.
Right.
Your average cost per share isn't the simple average of the prices. It's your total investment. $2,000 divided by total shares, 92.5. That works out to about $21.62 per share.
Which is much lower than the $50 starting price or even the $40 price in month 3.
Exactly. If you tried to time it and maybe hesitated or only bought high, you'd likely have fewer shares for the same investment. It reinforces that long-term thinking the sources stress.
That makes a lot of sense. Feels less stressful than constantly checking prices.
Right.
What do the sources flag as the main sort of pros and cons of DCA?
Yeah, they lay out several clear benefits. The big one we touched on, reduces emotional investing.
Takes the fear and greed out of it.
Right. The sources compared it to like a grocery budget. You allocate the money consistently. It also lessens the sting of volatility because you're actually buying more when prices are low.
Turns dips into opportunities in a way.
Kind of, yeah. It encourages that long-term view. It's super accessible, especially for new investors. Lots of platforms let you set up automatic contributions.
Makes it easy.
And simple. You're not trying to be a market wizard predicting trends, but, it's not perfect. There are drawbacks the sources mention.
Like what?
Well, potential for higher overall costs if you compare it to investing a big lump sum right before the market takes off on a long bull run.
Ah, the opportunity cost.
Exactly. If the market just goes up and up from day one, that lump sum invested earlier would have bought more shares at the initial lower price. So you might miss out on some gains in that specific scenario.
Okay.
DCA isn't always the best fit for, say, highly speculative individual stocks where the price swings are maybe less predictable than a broad market index.
Gotcha.
It definitely requires discipline. You have to resist that urge to stop investing when things look scary and the market's falling.
Yeah.
Sticking with it is key.
That takes guts sometimes.
It does. And finally, you give up control over the exact price you pay. You can't wait for what you think is a bargain. You just buy on schedule.
So it seems really effective for building that steady habit, smoothing out the bumps, especially with broad things like index funds. But it doesn't guarantee the absolute best possible entry price.
That sums it up well. It's presented as a really solid tool for long-term consistency, particularly if you want a less stressful path than trying to time the market perfectly. And this idea of consistent investing, it flows really naturally into the next big principle from your materials, diversification.
Right, okay, this is where it gets really interesting, I think. So you're putting money in regularly using DCA, but where does it go? Diversification. We all know the saying, don't put all your eggs in one basket. But according to these sources, why is this just so fundamentally critical for investors?
Well, diversification, as they describe it, is basically spreading your investments around, putting them in a variety of different assets.
Not just one stock or one type of bond.
Exactly. And the main goal is managing risk. But it can also help you capture potential returns from different parts of the economy or market. Its importance is multifaceted. The most obvious benefit is risk reduction.
Makes sense.
If one area tanks, say tech stocks have a bad year, hopefully other parts of your portfolio, maybe bonds, maybe international stocks are doing okay or even well, they can cushion the blow.
Like the stock versus bond example they used during a downturn.
Precisely. Stocks might fall, but high-quality bonds might hold their value or even go up as investors seek safety. It balances things out. It can also potentially enhance your overall returns over time. By having exposure to different sectors or asset types, you might catch growth wherever it's happening.
So you're not betting everything on one horse.
Right. And a diversified portfolio generally tends to be less volatile. The ups and downs are smoother compared to putting everything in one place. If all your eggs are in one basket and someone drops it, well,
Yeah, total loss.
It also kind of acknowledges that markets are complex and unpredictable. Lots of factors influence them: economic news, politics, consumer trends. Diversification is a way to hedge against that uncertainty.
And it supports that long-term view again, right?
Absolutely.
Yeah.
Reduces the need to constantly make perfect bets on individual things. Fosters patience. And that story about Mike in the sources, that really drives it home.
The tech stock guy.
Yeah. Built up a lot of wealth, but is heavily concentrated in tech. Then the dot-com bubble burst.
Ouch.
Big ouch. Alarming losses. The sources point out, if he'd been diversified some in healthcare, utilities, maybe some international exposure, the hit to his overall wealth wouldn't have been nearly as devastating. It's a serious cautionary tale.
That really lands the point. So if you want to avoid that kind of scenario, how do the sources suggest you actually implement diversification effectively? What are the strategies?
Okay, they outline a pretty robust set of strategies.
Hmm.
The core idea is spreading investments across different asset classes. Things like stocks, bonds, real estate, and cash, or cash equivalents, like money market funds. These tend to behave differently in different economic conditions.
Give me an example.
Sure, like during periods of high inflation, commodities or maybe certain types of real estate might perform well. But bonds, especially fixed-rate ones, could lose purchasing power. Having a mix helps balance that out. They even provided that sample asset allocation, just as an illustration, remember.
Vaguely, yeah.
It's something like 50% stocks, but spread across different types. 30% bonds, a mix of government and corporate. 10% real estate, often through REITs, those real estate investment trusts you can buy like stocks. And 10% in cash or equivalents for stability and liquidity.
Okay, so spreading it across the big categories first.
Right. Then, within stocks, they advise diversifying across different sectors.
Like tech, healthcare?
Exactly. Technology, consumer goods, energy, utilities, financials, healthcare. These industries react differently to economic cycles. A downturn that hits travel might not hit healthcare providers as hard, for example. Geographic diversification is another key piece, including international stocks or funds.
Why is that important?
It hedges against problems specific to one country's economy or market. If the U.S. market is flat, maybe Europe or Asia is growing. And this is where index funds and ETFs really shine, according to the sources.
ETFs being exchange-traded funds.
Right. Similar to index funds, often tracking an index, but they trade on exchanges throughout the day like individual stocks.
And they help with diversification? How?
Well, buying just one broad market index fund like an S&P 500 fund instantly gives you a small piece of 500 large U.S. companies across many different sectors. Boom, instant diversification.
That is efficient.
Very. And the sources highlight the advantages. Typically lower fees, that instant diversification we mentioned, and it's easy to see how they're performing because they just track the index. They also briefly mentioned diversifying by company size, mixing large cap stocks, big stable companies, with mid-cap and small-cap, smaller companies with potentially higher growth but maybe more risk.
Finding a balance there.
Right. And for some investors, maybe adding a small slice of alternative investments, things like commodities, maybe even collectibles, though they usually suggest keeping that part small. But, and this is crucial, they stress that diversification spreads risk, helps manage it. It doesn't eliminate it completely. Markets can still go down overall.
Got it. It's about building a more resilient portfolio and not making it bulletproof.
Exactly. A smoother ride towards your long-term goals.
Okay, that makes total sense. So picture this. You're consistently investing using DCA. You're putting that money into a diversified portfolio, maybe using index funds and ETFs. But like you said, markets move. Some investments will do better than others. Things drift.
They inevitably do.
Which brings us squarely to the third pillar the sources highlight. Regular rebalancing. What exactly is rebalancing, and why is it even necessary if you've already diversified?
Right. Rebalancing is, well, it's essentially portfolio housekeeping, but really important housekeeping. It's the process of bringing the proportions of assets in your portfolio back to your original target allocation.
The targets you set when you decided on your diversification strategy.
Exactly. As you said, drift happens. Let's say you aimed for a 60% stock, 40% bond mix. If stocks have a stellar year and bonds stay flat, your portfolio might naturally become, say, 70% stocks and 30% bonds just because the stocks grew so much.
Okay, so it's drifted away from the plan. Why is that a problem?
It boils down to risk management. That 70-30 portfolio is now riskier than the 60-40 portfolio you initially decided was right for you.
Because stocks are generally considered riskier than bonds.
Correct. Letting one asset class grow unchecked can push your overall portfolio risk level beyond your comfort zone, beyond what aligns with your goals. Rebalancing forces you to periodically sell some of the winners, the assets that have grown, and buy more of the underperformers to get back to your target weights.
So you're locking in some gains and buying low, in a sense.
That's often a byproduct, yes. But the primary goal is maintaining your desired risk level, keeping things aligned. Remember Jessica's scenario from the source material?
Hermione.
She started with a target of 70% stocks, 30% bonds. The stock market soared. Her portfolio naturally drifted to 85% stocks.
Wow, that's a big shift.
Huge. And the sources pointed out that left her way more exposed if the stock market suddenly turned south. way more vulnerable to bigger losses than her original 70-30 plan intended. Neglecting rebalancing essentially meant she was taking on more risk than she planned.
So rebalancing is like a proactive safeguard against that risk creep.
That's a great way to put it, proactive risk management, maintaining balance.
Okay, makes sense. So it's not just about tidying things up, it's actively managing your risk exposure. How do the sources suggest you decide when to actually do this rebalancing? Is it like every January 1st?
They outline a few common techniques. The simplest is probably time-based rebalancing.
Like you said, January 1st.
Could be. You just pick a schedule, maybe quarterly, maybe semi-annually, maybe annually. And on that date, you rebalance back to your targets no matter what the market's done recently.
What are the pros and cons of that?
Well, the pro is discipline. It forces you to do it regularly and takes emotion out of the timing. The con is you might let things drift quite a bit between dates, or you might rebalance even if things are still pretty close to target. Another popular method is threshold-based rebalancing.
How does that work?
Here, you set specific limits or thresholds. For example, you might say, if any asset class drifts more than 5% away from its target percentage, I'll rebalance.
So it's triggered by market movement, not the calendar.
Exactly. If your 60% stock target hits 65%, boom, time to rebalance, even if it's only been 2 months since the last time.
Advantages and disadvantages.
The advantage is flexibility and responsiveness. It keeps your risk exposure much closer to your target because you act when significant drift occurs. The potential downside is you might trade more often, which could mean more transaction costs or possibly tax implications, depending on the account. And you need to decide thoughtfully what that threshold should be, 5%, 10%. And as mentioned in the sources, a lot of people use a hybrid approach.
Best of both worlds.
Kind of. Maybe review quarterly, time-based, but only actually rebalance if a threshold has been breached. It combines discipline with responsiveness. The sources also mention automated tools, robo-advisors, for instance.
They can do it for you.
Many of them do, yes. They'll automatically monitor your portfolio and rebalance back to your target allocation based on the rules you set or their algorithms. It takes the effort and emotion out of it for you. And crucially, beyond just the mechanics of when to rebalance back to targets, they stress periodically reviewing the targets themselves.
Adjusting the whole strategy.
Right. Based on major life changes, new job, marriage, kids, approaching retirement, your goals might change, your ability or willingness to take risk might change. So you need to revisit your target allocation, not just blindly reset to old targets.
That's a really important layer. It's not set and forget forever. What about just the practical side? Any final tips from the sources on actually doing the rebalancing when the time comes?
Yeah, they offered some practical steps. First, regular monitoring is obviously needed, whether you're using time or thresholds. You need to know where you stand.
Keep an eye on things.
Right. Also, maintain realistic expectations. Markets go up and down. Rebalancing is a long-term discipline tool, not a magic way to guarantee short-term profits. Manage those emotional responses. They also strongly advise considering transaction costs and, importantly, taxes.
Yeah, selling winners can trigger capital gains tax.
Exactly. So being mindful of that is key. One strategy they mention is doing your rebalancing within tax-advantaged accounts first, like IRAs or 401ks, where those sales don't trigger immediate taxes. That can make a big difference over time.
Smart.
And finally, they suggest documenting your decisions. Keeping a record of why you set your targets and when you rebalanced can help you understand your strategy better and stick to it. So yeah, rebalancing isn't just optional tinkering. The sources frame it as a really crucial part of a sound strategy. It keeps you in control, adapts to market changes, and maintains that stable foundation aligned with your risk tolerance and goals.
Okay, let's try to pull this all together then. We've walked through dollar cost averaging for that consistent, disciplined investing.
Smoothing out the entry point.
Then diversification, spreading your risk across different assets, maybe using index funds and ETFs as key tools.
Absolutely. Managing that concentration risk.
And finally, regular rebalancing to keep that diversified mix aligned with your original plan and risk level as markets inevitably shift things around.
Right, maintaining the strategy's integrity.
It really sounds like these three methods work together as a powerful system based on what the sources described.
It absolutely does. The sources really emphasize that these three, especially when applied using accessible tools like index funds, create a very cohesive, holistic approach. It's about blending that potential for growth with sensible risk management. It makes for a much more robust financial plan overall. It's as much about the process and the discipline as it is about chasing the highest possible return number.
And looking back at the material you shared, it wrapped up with some final nuggets of advice, didn't it? For anyone embarking on this wealth building journey, what were some of those key takeaways?
Yeah, there was a nice summary list about 8 key tips. First one, set clear financial goals.
Know your why.
Exactly. What does wealth actually mean for you? Retirement, a house, kids' education. Having defined goals gives you direction and motivation. Second, stay educated. This is ongoing. Keep learning about markets, economics, different investment types. Read, attend seminars, maybe talk to an advisor. Knowledge is power here.
Never stop learning.
Right. Third, keep emotions in check. We've hit this a few times. Avoid making impulsive decisions based on market hype or fear. Trust the plan you built.
Easier said than done sometimes.
Oh, yeah, definitely. Which is why the discipline of DCA and rebalancing helps. Fourth, consider tax implications.
We just touched on that with rebalancing.
Yeah, using tax-efficient strategies, leveraging those tax-advantaged accounts like IRAs, 401ks were available. It can significantly boost your net returns over the long term. Fifth tip, stay consistent. Regular contributions are key. Let compound interest do its heavy lifting over years, even decades. It's incredibly powerful, but needs time.
The magic of compounding.
Truly. Sixth, be ready to adapt. Life changes. Your financial situation, your goals, your risk tolerance, they won't stay static. Periodically reassess and adjust your strategy. Don't be afraid to evolve the plan. Seventh, don't hesitate to seek professional guidance. If you feel overwhelmed, confused, or just lack the time or interest to manage it all yourself, a good financial advisor can be invaluable. They can help tailor everything to your specific needs.
No shame in asking for help.
Absolutely not. And the final tip, celebrate milestones along the way. Acknowledge the progress you're making. It helps keep you motivated for what is, fundamentally, a marathon, not a sprint. So, taken together, these tips really reinforce that building wealth isn't just a single decision, like picking one hot stock. It's a journey that requires patience, ongoing knowledge, a clear strategy, and consistent discipline. These methods provide a solid framework for that journey.
Well, we've certainly taken a deep dive today into building wealth with index funds, unpacking that powerful trio from your sources. Dollar cost averaging, diversification, and regular rebalancing. It paints a clear, actionable picture.
It really does. And considering how much the sources emphasized adapting your strategy to market changes, yes, but also to changes in your own life, here's a final thought for you to maybe mull over. Based on everything we've discussed from these materials, what one specific insight might prompt you to reevaluate an assumption you held about investing before we started this conversation?
That's a great question to reflect on. Thank you for sharing all these sources and walking through them with us today. Hopefully you, our listener, found this deep dive valuable. Keep exploring these concepts and think about how they might apply to your own path forward.